Welcome, everybody. For those who I haven't met personally before, Jack Kiley, MidAtlantic IRA. I'm one of the principals here. And to my left, anyway, is Siobhan. Anything technical, feel free to put it in the chat, or she can help you with it. Probably better than I can, because she'll be the first to tell you I barely know how the computer turns on. So don't ask me. As you guys know, since over everybody here is a client, we are a provider of self-directed retirement accounts. I'm a CPA by trade as well, so sometimes I get on the phone with clients and we do get into some tax subjects and what have you. We're a little better versed in that than maybe some other companies are, and this time of year too. If you're whoever's helping you prepare returns and what have you, if there's questions, don't hesitate to ask us. We're more than happy to talk to your advisors and your preparers and whoever else you feel you need help from, because all of this obviously happens in a very compressed period of time. When our topic tonight is choosing what is your investment strategy, and what's the best way to apply this in a self-directed account. And I think that a lot of people have a notion that investments in a self-directed account are wildly different from an investment somewhere else. And that's really not true. And that's one of the things I really want to dig into a little bit tonight. As all of you know, our niche here is investments, which we call alternative investments. So those are, that primarily for most of our clients, it tends to be either real estate related types of assets. Lending is probably the second, a close second as far as asset class goes. And then there's a spattering of other things, which include private placements, which many times are real estate pools of some sort. There's specialty real estate types of investments. So, for instance, maybe they're farming types of ventures, or other very logging, for instance, is another one that comes to mind. Very specific types of real estate based investments. And those tend to be in what are referred to as private placements, meaning that somebody is pooling capital from a large group of people, generally millions of dollars, and attracting investors to contribute capital and share in the wealth of whatever that investment is. So we're going to talk, we'll talk a little bit more about types of strategies, or what your strategy should look like, some of the roadblocks that people run into, and how to break through those. We're not pickers of deals. One of the beauties of self-direction is that we're not telling you what you have to invest in. You are able to choose your team, so to speak. So I'm a real estate investor like many of you guys, and I have my own guys. When I can, I use the same inspectors, I use the same settlement company. I use the same. And that's one of the beauties of self-direction, is you can use your team. Nobody is telling you who you have to use, or those sorts of things. So it gives you a large choice, and sometimes choice creates paralysis in and of itself. So we're gonna, again, we'll talk a little bit more about that. When I think of strategy, what really, the way to think of this is, what is it that what is it that you do? What is your strategy? What is your investment of choice? And actually, I'm going to step back a little bit because the other thing I think that people have a little trouble with is where does a self-directed account fit in their overall plan? And for most people, and this is a trait that I really see among successful users of self-directed accounts, and quite frankly, successful people in general, is they understand with clarity what they're doing or what they're using. So in for if you think about, I'm sure most of you, or some of you at least, have been through a financial planning model of sorts. And generally, this is sort of my 50,000 foot view. Investments or what you do in wealth building falls into three categories. There's what I refer to as a concentrated asset. And if you're an entrepreneur or a business owner, that's your business. That's your bulk of your income comes from that concentrated asset. Uh, if you tend to if you work for somebody else, you can think of it as a cash flow, as a stream of cash which comes from your employment. But most people, if you look at wealthy people, most of them derive their wealth from one of two areas, either a concentrated asset class, okay, like real estate, or a business venture. So they might be it might be their business, it might be a partnership, they may have started a small company, something along those lines. And but for most people, they have that concentrated asset, or that cash flow comes from something. Then they've got a pool of investments that have flexibility. Okay. And many of these investments tend to be one off from what their concentrated assets are. So I was talking to a guy earlier today who owns he's a partner in a biotech company. Okay. Which in the Washington, D.C. area, there's a lot of small biotech companies. And that's his concentrated asset. And then he's got these flexible investments, which are interests in other biotech companies and technologies and those sorts of things. So what you see a lot of times is people have that concentrated asset, and then they've got these other investments, which are loosely connected to whatever it is that they do. So people who are, for instance, in real estate, those flexible assets tend to be real estate types of assets. It might be rental property, it might be rehab projects. It could be maybe a partnership around an office building or an apartment building or something along those lines. But they tend to, again, those flexible assets tend to be loosely connected to whatever their concentrated asset is. And then they've got safety assets. So those might be money market accounts, savings accounts. Yeah, I would argue that you could put stocks and bond portfolios in this, because for most people, they're doing this on their own. And the reality is it is very difficult to beat the market. Okay, unless you're doing that as a full-time job, which most people do not. So the best you're going to do, or the best that you're trying to do, is to keep pace, right? Which is not really necessarily becoming or growing wealth. It's just keeping pace. So where self-direction sort of overlays this is in those flexible assets. So people are using retirement plan dollars to invest in these flexible assets. So again, these are things that you generally have a knowledge of. You like those sorts of investments. They're things that you do. They're tangentially related to whatever it is that you do for a living. And you have, again, you have a special knowledge of that. And, a lot of people who have heard me speak over the years, I talk about leveraging your knowledge, and that's precisely what I'm talking about here. So where self-direction becomes important for most people is they're investing in these flexible assets. And the bonus is that you're doing it on a tax deferred or a tax free if it's Roth environment. So sort of in that tax free or tax deferred zone. So if you are getting a 10% return, it's a true 10%. It's not an after tax, at the 7%. So your ability to grow wealth almost increases by twofold. So I think, my recollection, see if I remember this right, if you invested $100,000 at 10%, it would grow to somewhere around $375-ish thousand. If you did that in a tax deferred environment, so that 100,000 over the course of 20 years at 10% in tax deferred environment would be almost 790 or something. So it almost doubles, okay, just by not having to pay the 30%, which for most people is about 25% to the feds and about 5% to whatever state you're in. And if you're unlucky enough, like me, to be in Maryland, that's really not 5%. It's really closer to 8 or 9%. So, so again, thinking with clarity, where does self-direction fit into your wealth model? Okay. And if you sort of keep traded assets, flexible assets, and then your reserves, so to speak, you're probably in that middle ground, that flexible assets category, and you're doing it on a tax deferred as opposed to a taxable environment. So, everybody okay with that so far? I see somebody said I froze. Any questions on that? Okay. All right. So if you kind of keep that as a backdrop, the strategy that works best for you is the one that you use currently. Okay. And one of the beauties, if you will, of self-direction is that you can, generally speaking, anything that you do investment wise, you can do in a self-directed environment. There's only two prisms or two considerations that you have to think about. Actually, I'm going to say three considerations. One is your investment model, which, on this call probably isn't a problem for anybody. So it is, there's only a few things that you can't invest in a self-directed account. One of them is life insurance and the other's collectibles. Generally, that's not a problem. And then sometimes it's who you're dealing with. So who the account is transacting business with. So occasionally, if you're, for instance, if you use your mother, for instance, as a real estate agent, that's going to be a little problematic. But those are things that are easy to get around. In looking at your strategy in a self-directed account, the only real consideration is you have to maybe do a little. There's a little bit of forethought that goes into the investment. There's some of us, and this is true particularly of salespeople who are a little more art of the deal, back of the napkin kind of person. You've got to sort of take a breath and think a little bit or slow down a little bit, because in self-directed world, things don't necessarily move as quickly as you want them to. You could and a lot of people will do this. For instance, you might look at a property and put a deposit down right that day. Okay. In a self-directed environment, that becomes a little harder to do. Maybe it's the next day. It's not that day kind of thing. So it's a little bit of forethought. If you are a rehabber, for instance, you're thinking is if I'm putting a deal together and I'm rehabbing, and I know I got to buy a property for 100,000 and forget loans and all that for a second. If it's $100,000 piece of property and my fix up is 50, so I'm all in at 150. I know that a retirement plan has a finite amount of money in it. Okay, so and by that I mean that I can't add substantial amounts to the account if it's if it's a traditional IRA, for instance. I might be able to do that if it's a SEP or a solo 401k, but I have to contend with the fact that there's a finite amount of money in there, or there's little potential to add larger amounts of money. Okay. So if I'm looking at that project and I'm thinking I'm all in at 150 and I've only got $150,000 in my retirement account or 155, I'm not sure I would offer 100,000 for the property. I might offer 85 because I want to make sure that I have some cushion. Okay. Or I need a plan B. So I might talk at least loosely in advance to somebody else about if I need 25 or $30,000, for instance. Okay. And just so I've got something in my back pocket. Whereas, some people, they would just, I know a lot of rehabbers that just sort of wing it. I mean, they know they go out and they borrow money and they write, they've got they sort of, go through their plan of what the project's going to look like and this and that. But I can tell when I'm talking to them in the back of their mind, they know that they can go out and borrow money from somewhere or do something. Okay. And as an individual, that's a little easier to do because as an individual, I could pledge other assets. I could, if I had to find it, I could find it. But you have to keep in mind that your retirement account has to act on its own. So it can't rely on your resources. Okay. So anyway, the point of that is you have to have a little bit of forethought sometimes, or just a little pause and think maybe a little more clearly about what it is that what your business plan is going to look like a little bit. Okay. Um, you know, self-direction, you're not forced to a one size fits all. So, you have, again, as I said before, you have latitude. It's always nice. Um, the, that sometimes, you know, familiarity with an asset class or something is, you know, gives you confidence to invest or maybe not think everything all the way through. And I would suggest to you that, before any investment, especially real estate related assets, because you're committing large sums of money, um, you know, getting clarity around it, whether it's in a self-directed account or not, is a smart thing to do. Um, anybody have any questions about this so far? I can't see the chat, so I don't know if there's anything in there, Siobhan.
There's nothing in the chat. And if anyone does have questions, feel free to also raise your hand too.
We're good?
Yep, I think we're good.
Okay. All right. Sometimes what I find with self-direction too is that particularly with people who are newer to self-direction is sometimes because there are the field is wide open. Sometimes that creates paralysis in and of itself. So people come to self-direction and they think that there's going to be an imposed protocol, and there's really not. Okay. One of the things that we encourage you to do when you're contemplating an investment or you're thinking about it is to call the acquisitions team, because we want to make sure that it's on our radar screen, that you're looking to do something, or you're contemplating an investment, or if you want to run through the players, if you will, or your idea. We can help you with respect to, are there any disqualified persons? Are there any issues? Okay, because the one of the things that we hear, particularly for people who use some of the other custodians out there, is they don't want to see they don't want to see your paperwork until you have it all together at the end. And the reality is, it's really hard to 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 deal with workflow. For instance, if I don't know until today what deals are going to close tomorrow. Okay, that's why you hear horror stories about, I couldn't, I couldn't. It took them 3 weeks to fund my deal. Well, the problem is that they're not staffed. Okay, so if I know today, for instance, that we have 50 deals a week from Friday, they're all going to get done. Okay, so it's good to get with us early so that we know what's coming down the pike, and then we can help you. And if there's a hiccup, which sometimes happens, particularly with real estate. I think a couple of days ago, I remember I got a call from a client who was had to have was having an inspection on the property, and the inspector came across something, and he needed to bring somebody else in to look at whatever the issue was, and that other person wanted to be, he wanted to be paid right away before he was going to look at it. So that was something that we were able to deal with, because we already knew that the investment was in process. Okay. So and we've all, in real estate particularly, we've all run into sort of those headaches or those things that come up. And if we know early, then we can help you navigate some of those sorts of problems, okay, or issues. Sometimes too, there's one thing that you have to be mindful of, particularly in real estate, and this again is why you want to call us early, is that, for instance, when you're writing a contract, the retirement plan has to be a party to the contract initially. So you can't assign a contract from you to the IRA. Okay. So if you're buying real estate, for instance, and you're not really sure, even if you're not even sure you're going to put it in the retirement plan, what I always do is I'll put Jack or Jack IRA. So that helps. That gives me flexibility. And what that tells anybody that's looking at it is that, I might buy the property personally, okay, or I might buy it in my IRA, or there might be a combination, and maybe Jack and the IRA, which is possible too. So, that's, again, those are some of the reasons that you want to, talk to us early. And the other big reason too, quite frankly, is if it's a deal or if it's an investment that cannot be done in a self-directed account, it doesn't help you, and it certainly doesn't help us. Okay, to get halfway down the pike on a deal and then find out you can't do it. Okay, but quite frankly, probably about 95% of the things that you want to do, you can do with a little bit of structure. So there might, the way you've laid it out may not exactly be the right way, but with a little tweaking, you can get there. Okay. Siobhan, did I see some things fly through the chat?
Yeah, we have 3 questions in the chat. If you want
Okay.
to address them. So the first is from Alvaro. He's asking, can you, as a licensed real estate agent, buy a home with your own self-directed IRA?
So I think what you're asking is, can you broker your own deal? Okay. And the answer to that is yes, so long as you're not getting paid. Okay. So that means one of 2 things. If you're working for one of the, say Remax, for instance, they are not going to forego their commission, but they may allow you to forego yours. So of the, the 3% that comes to your side of things, you can't get paid out of the deal. Okay. Quite frankly, what a lot of people will do is they'll turn that deal over to one of their compatriots and then pick something else up on the backside from somebody else.
The next question is from Vicky. Can you elaborate on how to partner with your own self-directed IRA to purchase if you don't have enough money in your account?
Okay, sure. So, the partnering really, the easiest way to do this is to form an entity. So you might form an LLC, and the funding is going to come from both from you individually and from the retirement account. Okay. Percentage of ownership is going to be driven by money in the deal. So if, let's just create a little scenario. So let's say I'm going to buy a piece of property for $100,000 and I've got 60,000 personally, and I've got maybe I got another 60,000 in my IRA. What I very likely would do is go maybe either 50-50 or 60-40 to me personally, with 60% and my retirement plan 40, because I want to give my retirement account a little bit of wiggle room. Okay. So if I form an LLC, so I got Jack's Big Deal LLC, and I fund that with personal money of 60,000 and IRA money of 40,000, my percentage of ownership is going to be me personally 60%, my IRA 40%. Okay. So I can't skew those percentages, because if I do, then either me or my retirement account is getting a benefit from the other side. Excuse me, and that becomes prohibited. Okay. So if I have to add more money, it's got to be in that 60-40 percentage of ownership. Okay. And so the LLC is going to buy the property. If it's a buy and hold, it does what it does. Oh, excuse me. If it's a rehab, I do the rehab within the account. And then when on sale, I would distribute the funds back to the retirement accounts. The one of the things we've had a big discussion on over the years is, should I can I reuse that LLC? In other words, if I'm a rehabber, should I do deal number 1 and then deal number 2 and deal number 3? And my feeling is, and this is just me personally, this is not legalities or anything else. After each deal, I terminate the LLC. Okay. And the reason I do that is twofold. So first of all, any problems that are in the rehab most likely are going to die when I terminate the LLC. Okay. So if I had somebody that came in and put cabinets in the kitchen, right? One of my carpenters or something was putting the cabinets up, and 6 months later, a year later, one of the cabinets falls out. Okay. If the LLC is now terminated, the likelihood of the buyer coming after me is small because there's no entity anymore. Okay. Um, if I keep that thing alive, then there's always opportunities for the buyer of the property to come back and to get me to do something. Okay. The other thing is I might in my second deal or my third deal, I might want different percentages of capital from me in my retirement account. Okay. So once I start with that 60/40 percentage, I cannot skew that. I can't change, it's going to remain 60/40 for the life of that entity. Okay. Because the minute that I change that, then either me or the retirement plan is getting a benefit, and that's from the other side, and that's prohibited. Okay. And I think I saw a question sort of fly through there from Vicky, and I think that was,
You just answered it, yeah. Does
yeah, I
that make
think I
sense,
just
Vicky?
answered.
Yeah, she said that makes sense.
Okay. All right.
And then the last question is from Gina. Can self-directed IRA money be used to add funds to a grandchild's fifth 529 plan?
529. Um, if it's no, is probably the short answer. If you did, you'd have to pull it out, pay tax on it, and then contribute it to the 529. Um,
And I
you
think that
know,
was her second part of the question was what would the tax implications be?
yeah, yeah. And it's a little confusing because now 529 plans, if you hold them for, I think it's 20 years, the child, okay, who is the beneficiary of the account, if he doesn't or she doesn't use the funds, can effectively convert that to Roth. So that's kind of an interesting twist, if you will, to 529 plans. So
The last question. Gina says thanks.
you bet. That was it
Yep, that was
so
it.
far. Okay. All right. So, what are some of the common strategies that we see? In real estate particularly, it's rental property or rehabbing. Okay, those are probably the two biggest. Um, you'll people ask me about wholesaling a lot. Okay, wholesaling is, you'll see a lot of buzz and you see a lot of um, stuff, if you will, on the web about put $500 in an account and it's wholesale to your heart's delight. And quite frankly, you can't do that. There's a couple of issues with wholesaling. First of all, so let's just define what a wholesale is. Wholesaling is taking a property under contract, so controlling the contract and then assigning it to somebody else. So if I open up a retirement account with $1,000 or with $5,000 and I write a contract on a piece of property, $100,000 piece of property, and I deposit $1,000 and I ask for 60 days to sorry, I had a commercial interruption there. So but if I do that, so I put a property under contract and I sign a contract for $100,000. I put $1,000 down, and now I have control of that contract for 60 days. Legally, I've committed a fraud. Okay. Because the retirement plan, on a $5,000 assets in a retirement plan, I cannot buy a piece of property for $100,000. Okay. And somebody usually will sit there and say to me, well, the IRA could go borrow money. And there is not anybody that's going to lend an IRA, a $5,000 IRA, $99,000 on a piece of real estate. Okay. It's just not, it's not going to happen. If a bank's not going to do it, and that would be the threshold, then you've got a problem. Okay. So if you have $100,000 in your IRA, or you had $60,000 or $70,000 in your IRA, then could you reasonably wholesale? Yes. Okay, you could do that. But if you're opening up an IRA, or you have IRAs and you have small amounts of money, that's not going to get you. That's a bad get rich quick scheme. So, I see that out there a lot, and I see other custodians or salespeople pushing that, and it's a recipe for disaster. Okay, so wholesaling generally is not a great strategy for self-direction. The other problem that you have, quite honestly, with this, and this is sort of my compliance and my CPA brain going off here, is that technically wholesaling is a service. It's a personal business. Okay. It's not an investment activity. IRAs, because they're not people. Okay. Can't perform personal services. So I've seen one or two court cases around that as well. So, although that doesn't, again, the IRS doesn't get too in the weeds about that, but the Department of Labor, who is the other big has oversight over retirement plans, does. So every once in a while, I'll see that as an issue as well. But other activities in real estate are very common. So rental property, rehabbing, interests in partnerships, those sorts of things. And then the other big activity that we see is lending, is either private lending or even hard money lending. Okay. And, lending is a little bit all over the board, because you can, the only thing that you really have to be careful of in lending is that your interest rate is either too low or too high. And a lot of that is just dependent on jurisdiction. So I think, for instance, in Maryland, I think you can, the highest interest rate is somewhere like 23% or something. And some states it's as low as 19, other states it's as high as 29. So it just depends on where your debtor is. But all of those, those are the most common strategies that we see, and they're the ones that we get asked about all the time. So again, for those of you in real estate, probably everything that you're doing now can be done in a self-directed account. The other thing that I get asked a lot is if I set up a partnership, or an LLC around a piece of property, and I'm contributing IRA money, and I've got somebody else that's going to be the boots on the ground, how do we structure that deal? How do we structure partnership interests? And unlike when you're dealing with yourself, unlike Vicky's question, where it was Vicky and Vicky's IRA, where the percentage of ownership is driven by money in the deal, when you're negotiating or coming to terms with somebody who is not a disqualified person, so somebody that's not related to you, or there's a couple of other gates, but generally these tend to be relatives. If it's somebody that's not a relative, you can strike whatever deal you want. So if if you're the money and somebody else is the sweat equity, and you negotiate 25% to them and 75% to you, even though you're putting in 90% of the money, that's acceptable. Okay, that's not a problem. Okay, and the reason for that, unlike the situation that Vicky was talking about earlier, is because they're not related parties, they're not disqualified persons. Okay, so when we see, we do those deals in real estate all the time, and we see them all the time in self-directed accounts. Okay, um, you know, um, the other, it's not unusual these days too, where people are investing in property that's out of market. So again, I'm in the Washington, D.C., Baltimore corridor. Okay, property's very expensive here. So I am not bothered by buying a property, for instance, in the Midwest. Okay. Um, so if you have resources, or you're able to make those sorts of investments, you can certainly do that in a self-directed account. And again, I think at least for me, I just have to be comfortable with whatever, with that, whatever it is. Okay. But again, whatever structure I can create around that, I can certainly do that in a self-directed environment as well. Okay. Um, so you can keep those things in mind. Um, the any questions about that so far? Okay. Um, the the other thing that I hear people talk about from time to time is time horizons, and how long should an investment be, and those sorts of things. Self-directed accounts are not, that it's up to you. It's what you're comfortable with. So, we have clients who are older, whose timelines might be longer than mine would be. Okay. And that's perfectly acceptable. Or, there are clients that are younger that have very short timelines, for instance, and ordinarily they might have longer timelines. But I think what happens is people are they've been conditioned to think of self-directed accounts solely as retirement accounts. And when you talk to financial planners, and you talk to uh, you talk to people who are in the investment business, they think of retirement accounts for retirement. So they're thinking in terms of assets need to be liquid by the time you reach an anointed age. Okay. You know, most people who are using self-directed accounts, again, are thinking, who are using them effectively, I should say, are not thinking of self-directed retirement accounts as retirement accounts only. They're thinking of them in terms of tax deferred, or if they're Roth, tax-free accounts. Okay. So it gives you, again, as I said before, it gives you the ability to build up assets, or to build up wealth faster, because the compounding, you don't have the 30% tax component to contend with. It can just grow tax deferred. Okay. You'll hear arguments about, well, it's the same amount of money whether I pay the tax now or I pay the tax later. Well, that may be true in terms of pure dollars. Okay. But when you take the time value of money into consideration, it becomes significantly less in a self-directed account. Secondarily, in self-directed accounts, when you pull money out is when you pay tax. So theoretically, you're paying tax on money on consumption, right? Money that you're going to spend, okay, as opposed to production. So as you buy and sell and accumulate assets in the account, you're not paying tax on the production of income or wealth in those accounts. You're only paying tax at the point that you pull it out. Okay. And again, that tends to be consumption as opposed to production. So, one of the things I really want to try to get you to do is to think of this more again as a tax deferred or tax free account as opposed to purely for retirement. Okay. So, unless in your financial plan, you need a certain amount of liquidity or you have a timeline, you want to stay true to whatever that is. Okay. Whether you're in a retirement plan or outside of the retirement plan. Does that make sense?
He has a question going back to the partnering and the LLC structure.
Mhm.
She asked, once you lay out any upfront fees, the self-directed IRA must reimburse you, correct?
Well, the self-directed account can't reimburse you. So in a perfect world, if you're going to set up an entity, okay, or you're going to partner, what you want to do is you want to set the entity up and then have the funds deposited to the LLC, both your funds and the retirement plan funds, and then pay those expenses directly. So a lot of times, what one of the questions that I get a lot is, should I have a lawyer do this or can I do this? Okay. My feeling is that you should pay a lawyer to do it. Okay. And the reason for that is twofold. First of all, you can't pay for anything on behalf of the retirement account. Okay, that's prohibited. So if you're going to go out online and set up an LLC in Maryland, Maryland wants, roughly $200 in fees to do that. Okay, so how are you going to do that if you're setting it up? Well, you could get somebody else to pay the fees that's not related to you. Okay, you could certainly do that, or you could get a lawyer to do it, and they'll basically they'll charge the LLC for those expenses. And once it's set up, you do it. The other reason that I would want a lawyer to do it is I don't want a defective LLC. Okay, so if a lawyer draws up the LLC and it's deemed to be defective for some reason, then your recourse is, well, that dummy set it up for me. Okay, so you've got some cover, if you will. Okay, if you set it up yourself and it turns out it's defective, then you got a problem because there's nobody to blame but you. Okay. So I see a couple of other things. Oh, Siobhan's answering this.
Yeah, Alvaro asked basically if it was a $60,000 property with $40,000 rehab costs, can your IRA use the 60K to take down the home and you fund the 40K from your cash account? So in the end, it would be 60/40.
No, you can't. Siobhan's answer is right. You can't do that. And this is where the planning, if you will, or the thinking ahead comes into play. So when you're partnering with the retirement account, you want to you need to you almost work backwards. Okay, so again, if I know that I got to buy a property for 100,000 and I got to put 50 in, so I'm all in at 150, and I'm going to pad it. So maybe 175 or $180,000. Then I look at where my funds are. Okay. And I determine what my percentage of ownership is going to be, and then contribute that amount of money to the retirement account. Because when you're partnering with the retirement account, every expense has to be paid in proportion. Okay. And let me just step back and talk about the rules for a minute. Okay. So when we're talking about disqualified persons, again, these are people that the retirement plan cannot do business with. Okay. By do business is defined by any financial transaction. So buy, sell, lend, lease, borrow from, and then a couple of other things. So for instance, facilitate, guarantee a loan. Okay. Those are all prohibited between disqualified persons. So disqualified persons fall into three categories. Most of them tend to be family members. So if you put a dot out there in space and you draw a vertical line through that dot, anybody that's on the vertical line is disqualified. So that's your ascendants, descendants, spouses. Okay. Entities that they control. So this is a good graphic, and Siobhan's more than happy to send this to you if you want it. Okay. The second are people that work on the account. So if you have an IRA with us, for instance, I could not buy an asset out of your IRA because I work for the IRA. We're too close. Okay? And then there's certain other business relationships, and this is kind of best defined by example. So if Bob and I are partners in an entity, we're partners in an apartment complex, and Bob owns 10% and I own 8%. We are not disqualified because we just happen to invest in the same thing. Between the two of us, we can't control it. We don't get to make decisions. We're just catching payments just like everybody else is. But if Bob owns 35% of it and I own 25% of it, now we are disqualified because between the two of us, we control the asset, and it's a substantial part of our, individual wealth. Okay. So if something happens, it's in my best interest to make sure something doesn't happen to Bob and vice versa. Right. And the government, where these become important, or where this, why the government cares about this, is the government is concerned with people being able to move assets or properties or things from generation to generation or taxable to tax deferred environments, because of course the government thinks that you should pay your fair share, right? And that includes these things. And they don't want to get in the middle of determining what value is and all those sorts of things. So if we're back to, or we shift back to the partnership arrangement, if in Vicky's case, she sets up a partnership or an LLC, and she owns 60% of it, and the IRA owns 40% of it. If she contributes more money to the LLC, then she is giving a benefit to her retirement account. Okay, and that becomes disqualified. That's why if you add more money, it's got to be in proportion. Okay, so if we're in that 60-40, then she has to contribute 60%, and the retirement plan has to contribute 40. Okay, now, if Vicky decides at some point that she's going to bring in a partner, okay, the partner cannot be disqualified, so it can't be on this matrix. So let's just say that she's going to bring in Bob. Okay. and Bob is, Bob's going to contribute money to it. She can bring him in because he's not disqualified, but her percentage of ownership in relation to her IRA has to remain 60-40. So if Bob comes in and he's going to put in, and it doesn't matter the amount of money, but let's just say that it's for a 50% interest. Okay. So now Vicky's personal percentage is going to drop to 30, and her IRA's percentage is going to drop to 20, because 20 to 30 is 60-40. Okay. So she is going to be, with respect to her IRA, she's going to remain in that 60-40 relationship. Okay. Does that make sense to everybody? Quite frankly, I spend probably about half my day just talking about these sorts of issues.
Nikki also asked, can the self-directed IRA purchase of the real estate be in a trust?
I'm not sure what you mean by that. You can unmute yourself if you want. That might be
Trust
easier.
versus an LLC, she
Oh,
said.
yeah. So if you set up a trust and the two beneficiaries, one is the IRA and the other is the you personally, you could certainly do that. Okay, that's more prevalent, for instance, on the West Coast than it is here on the East Coast. Okay, that sometimes you'll hear the term business trust. You know, people do that a lot of times out in California, for instance, because to set up an LLC is at minimum $1,000. Where in Virginia it's $50, in Maryland it's 300. So we see a lot more trusts out west than we see here. Anybody else? No, SDA, you're right. SDA. So for those of you that don't know, SDAT stands for State Department of Assessment and Taxation. And in Maryland, that is that's where you get your corporate charters from and those sorts of things. Okay, so LLCs, corporations have to be registered with the SDAT. All right. Um, the other thing that I see a lot too is that people will utilize their self-directed accounts, and this is true actually of all retirement accounts. There can be an estate planning. They can be an estate planning tool. So we have clients that will structure their accounts based on beneficiaries, for instance. So the nice thing about retirement plans is they pass outside of probate. Okay. So in most states, I think actually maybe all states, but it is it's a way to move assets from generation to generation or spouse to spouse very quickly on somebody's death. A lot of times what we'll see, there's a lot of buzz now around Roth IRAs and Roth conversions and those sorts of things. And we've had a number of clients that are converting to Roth for two reasons. Okay, first of all, they move from that taxable environment to the tax-free environment, and they pay the tax at their choosing as opposed to the IRS's choosing. And then when, if that asset or those assets are left to beneficiaries, under current rules, beneficiary IRAs have to be paid out by the end of the 11th year after death. So there's a 10-year run on those, and then the assets must be distributed. If it's a traditional IRA, that could be a significant tax load to the beneficiary at the point of distribution. And that could be earlier, but it certainly at 10 years, it's going to happen. If it's Roth, it's just tax-free. It's just if assets are just retitled to in personal name. So there are estate planning considerations around self-directing, and they can be very creative. So that's you might those are some other considerations. You know, uh, Roths don't need to step up in basis. Whoever asked that question. So a Roth is a free is just free. Okay. Um, the you know so when you're looking at Bill, when you when you're looking at your strategy again, think about the self-directed accounts in the context of the tax deferral component of this, or tax free. It fits very nicely into whatever your strategy is, because there's very few things that cannot be done in self-directed environment. And I think, again, people sort of get boxed in. They think that this is something that has a lot of special rules and a lot of it's a separate box, and really it's not. Self-direction, the only thing self-direction really means, quite frankly, is that you're able to buy or invest in a wider spectrum of investments than a traditional IRA. Most people are familiar with stocks and bonds, and they think that that's it. Self-direction just opens you up to all the other opportunities that you could potentially invest in. Okay. Um, you want to make sure that that whatever your framework is, okay, or whatever your investment model is, Siobhan has a saying of, you want to stay in your lane. If you know what your investment model is, you want to stick to it. If it's been successful for you, stay with it. There's no need to change it, and you don't have to change it. If you're going to try something new or something that you haven't done before, if you're thinking of doing that in a self-directed environment, I might start small, okay, until you're sure that you like that strategy, okay, or whatever it is new that you're going to try. Um, so the that's the only other thing that I would really want to add to this is, if you have, in thinking about this, if you're self-employed or you have a business, there may be an opportunity to open a retirement plan connected to that business, be it a SEP or a simple or a solo 401k, which again would allow you to do whatever it is that you do in your concentrated activity or in your those flexible investments in a tax deferred environment more readily. I can tell you, in my tax practice, one of the things when I'm talking to entrepreneurs and we're talking about making contributions to retirement plans, one of the big hesitations I hear is, well, I might need that money for capital to do, for my business. Well, if you're able to conduct those business activities in a self-directed account or in a tax deferred environment, then that argument sort of goes away, okay? Because you're using those funds for that same purpose. So again, it's a way to shift capital from taxable to tax deferred or tax free, and still do what it is that you're doing. Um, the you know any questions on any of this? Or makes sense? All right. I think that's about all I have tonight. Hopefully, we gave you a couple things to think about. If you want some more information for those particularly who are maybe newer at this, I think March 4th, we have a webinar, which is understanding self-direction. So it's a little deeper dive, I think, into uh, the nuts and bolts of how the IRA works, how to what the process is and those sorts of things. You can sign up for that on our homepage. Uh, we also on the 9th will have a tax season prep, if you will, webinar meet up here for um, people who whether a lot of times that's about the period of time that a lot of our clients are getting their tax information together. What is it that you have to think about, or what might be some tax aspects with respect to the retirement account, or what's the interplay with your personal return. So we'll go, we'll talk about that, and you'll see some details in that on this Sunday's missive that we send out to you guys. So stay tuned for that. If there's no other questions, I'm gonna let you guys go about your day. I'm gonna go. I'm sure my wife has a few things that I can do here around the house, so I'm gonna get to that. So I hope you have a great night, and I'll see you soon. Take care. Bye bye.